Hello and welcome back to All Things Money. I'm your host, David Blain. During the first segment, we were talking about rising interest rates and bonds and diversified portfolios, and we're going to continue this segment talking about whether it's still a good idea or not to continue to hold bonds in a diversified portfolio. If you missed the first segment, we'll post an archive copy of it on our website, www.dlblain.com. Here in a couple weeks you can catch up. But the gist of it is we build diversified portfolios for people based on their goals, their rate of return requirements, as well as their risk tolerance and risk capacity. And a part of those portfolios continues to be bonds, high quality U.S. government bonds, emerging market corporate bonds, possibly emerging market bonds, foreign bonds, things like that. So the conventional wisdom is that rising interest rates will just destroy the bond investor and that you should get rid of your bonds because they're only paying 1 or 2%, and if rates go up, you're going to lose all kinds of money. Now, granted, from this low interest rate environment, the dampening ability of bonds is somewhat muted, but we still think it's worthwhile that when the stock markets go down, high quality bonds, now, junk bonds and things like that, they are not going to provide you that buffer. But high quality government and corporate bonds, when the market goes down, they typically provide a buffer and go up. Now, from this low interest rates, they may not go up like they did in 2008, but they should continue to provide that downside protection to the portfolio. So if you're have a low risk tolerance or you don't like to see your portfolio fluctuate in value, there's still a valuable part of the portfolio. And now we want to touch base on some historical. What happened, we have seen since 1981. In 1981, the one-year Treasury yield reached a yield of 14%. I mean, can you imagine that? A one-year Treasury yielding 14%. Actually, a lot of you out there don't have to imagine it. You lived it. I personally, in 1981, I was working already. I had a bunch of jobs as a young man in high school and was investing. And my dad took me down to the local bank. I think it was called Sovereign Bank in Northern Virginia. And I remember getting these CDs, these 1 and 2 year CDs, and they were paying 13, 14%. So I remember it too. Anyway, today the 1 year Treasury yields around 0.1%. So we've gone from 14% down to 0.1%. Never before have interest rates fallen, so far. So is history any help here? Well, we don't have this exact scenario, but we can look at other times in history. Typically, when interest rates go up, the value of bonds go down. And right now, it's not if, but when is that going to happen seems to be the conventional wisdom. Well, we think that a diversified portfolio that continues to hold bonds is going to have some value, and that you should not fear this great catastrophe if you keep your maturities somewhat short term, short intermediate term. If you go out 20, 30-year maturity, different story. We're talking about bonds that mature, somewhere between 3 to say 10 years. So we looked at some historical bond funds. A lot of investors use mutual funds. There's only 5 bond funds that have an inception date before 1960. But if we look at the returns from 1963 to 1981, which was a time period when interest rates were rising, we see that an equal weighted combination of those 5 bond funds returned about 4.15% annualized. So, nothing tremendous there, but they certainly did not have this great wipeout of bonds. Now, that's only 5. There weren't a lot. So we can also look at some indexes. We look at the Barclays, now the Barclays Capital Aggregate Bond Index, and it didn't start till 1976, but we see during the next 10 years, interest rates went up by about 3%. The index didn't have a single down year and produced an average annual return of 10.49%. That's between 1976 and 86 when interest rates went up. So that's helpful. As we look at some Treasury bond indices, some statistics here from that 1963 to 81 period, interest rates tripled during that time period, 1963 to 1981. We see the 20-year Treasury bond had a 1.28% annual return. The 10-year Treasury bond returned 3.37% annually, which is where we would recommend keeping the duration anyway, somewhat shorter. So once again, not huge returns, but not a complete wipeout. Now remember, you have inflation in there as well. So during that same 63 to 81 period of rising interest rates, Treasury bills earned an average annual return of 6.29%, where inflation was 6.12. So even the shortest maturity, remember Treasury bills are Treasury instruments that mature in 90 days or less, they kept pace with inflation. And the longer term or intermediate term government bonds also had a similar story. So they are able to keep up with inflation, because what happens in a rising interest rate, you have people actually attracted to the bond market, the higher interest rates. And so it becomes a supply and demand thing, as you have people maybe with cash on the sidelines or something else, and they see interest rates going up, and so they're actually buying into the bond market. And so those higher coupons tend to offset any decline in price due to the rising interest rates. So it's not a foregone conclusion that rising interest rates are going to destroy the return for bond investors. Well, that brings us to our end of our second break. If you have any questions on that, please feel free to contact us. So for All Things Money, I'm your host, David Blain. We'll be right back after a few short messages.